Welcome to a new episode of PE Forum. Today we're joined by Alan Gauld, Senior Investment Director at Patria and Lead Portfolio Manager of the Patria Private Equity Trust. With a decade of experience at Patria and a strong track record in sourcing and executing private equity investments across Europe, Alan brings deep insights into fund and direct investments. He has a particular focus on pan-European, Nordic, and Iberian managers and serves on multiple LP advisory committees. Before joining Patria via SWIP acquisition, he worked in private equity at Lloyds Banking. Alan, thank you so much for joining us today.
Thanks, Khaled. Pleasure to be here.
Great. So I just wanted to start and discussing, you have a particular model, which is the trust model. So, I mean, if you could tell us about, how listed private equity trusts differ a little bit from, the rest of the market.
Yeah, so maybe if we take a step back, so the investment trust itself as a vehicle has been around for around about 150 years, unbelievably. So there are a number of trusts outside of the private equity space that have been around for over 100 years, which is, I always find that quite incredible. And it's a little bit confusing in terms of the name because it's not actually legally a trust per se. It's simply a listed company. And it's a company whose reason for being is to hold investments. So has a set number of shares, for example, has an independent board, doesn't suffer redemptions or anything like that. So this sort of closed-end structure is ideal for holding illiquid assets. So things like real estate, like infrastructure, and obviously private equity. So private equity trusts have been around for around about 4 decades, really as long as the asset class itself. And the idea of the trusts back then was to democratize private equity because, we know that private equity is dominated by institutional investors and has been since its inception, really. So these trusts were put in place to open up for smaller investors like retail investors. So the beauty of it is that they allow smaller investors to buy and sell pretty much whenever they want because they're a listed stock. It's about selling on the secondary market, and so they're daily traded instruments. So the liquidity feature of PE investment trusts is very important. And in terms of our trust itself, Patria Private Equity Trust, so it's been around, well, it's in its 25th year. It used to be known as Standard Life Private Equity and Aberdeen Private Equity Opportunities. And we're focused with this trust on the European mid-market principally. We make investments alongside a small group of GPs, typically around 15 GPs, that we consider amongst the leading GPs in the market.
I want to touch on the point that you mentioned, because you mentioned retail, and today there's a big theme around private equity, which is democratizing access and making it more available. And you have a lot of instruments that are being created for that. Do you feel that in fact you're already providing this solution?
Yeah, I mean, I think private equity trusts have been providing that solution for 4 decades, in essence. I mean, there's literally hundreds of retail shareholders or individual shareholders on our shareholder register in Patria Private Equity Trust, and our peers will have the same situation. So we're talking about, hundreds, if not thousands, of individuals that are able to invest in private equity when they wouldn't have been able to do that historically through a limited partnership structure. And obviously there's innovation in the sector, and we welcome innovation, seeing that the likes of semi-liquids, emerging over the last few years. But I think that the liquidity feature of investment trusts has made it quite appealing to individuals for decades, really.
Alan, could you tell us more about how Patria Private Equity Trust differentiates itself in the private capital space?
Yeah, so it's an investment trust that's been around for well, it's in its 25th year now. So it's on the London Stock Exchange. It's in the FTSE 250, and it's been focused since its inception in 2001 on the European mid-market. So we're about 75% of our underlying portfolio companies are headquartered in Europe, and by mid-market we're meaning businesses at entry that are between 100 million enterprise value and a billion enterprise value. The trust itself is about, well, it partners with around 15 GP relationships at any given time that we consider to be amongst the market leaders in the private equity space. And we partner with those GPs through funds, whether that's on a primary basis at the start, whether it's a secondary midway through the life, or we partner with them through direct investments as well, so single asset secondaries or co-investments. So that's how we create this exposure, and direct investments are around 28% of our book. The trust pays a quarterly dividend, which has grown every year for the last 10 years, and we aim to at least maintain the value of the dividend in real terms. So yeah, and performance. I mean, over the long term, it has delivered an annualized NAV total return of 11% since 2001 when it listed. Over the last 10 years, it's been around 14.1% annualized, and that's been 14 consecutive years of NAV growth for the trust as well. So yeah, that's the trust.
And have you measured, if you compare to an LP in a fund, when they get, their payback, their investment payback and their returns, compared to what shareholders of a trust and the Patria Trust, Private Equity Trust gets in return? Is there a sort of a discount on this value to make for this structure, or is it pretty much similar?
Well, if you look at our returns over the last 10 years, our annualized NAV total return is around 14.1%. And the share price total return is 13.4%. It's delivered for shareholders over a long period of time. If you take that on a cumulative basis, over the last 5 years, you've practically seen a doubling on a total return basis of your NAV. So we think that that's comparable, and the beauty of these structures in the trust is they're evergreen. So as cash comes back into the portfolio, you're reinvesting that again, and you've got that compounding effect. Whereas, obviously a limited partnership vehicle, you're making a commitment that takes time for that to be drawn, and it takes time for the money to come out. So an IRR is slightly different. You don't have that same compounding effect. You'd have to create that at your own portfolio level. So yeah, I mean, the returns of these vehicles have been good and have been, well, demonstrable for a long time.
And so you've mentioned Patria Private Equity Trust NAV, and you mentioned the strong performance that you've achieved. But if you look at the share price, it's always discounted. It trades at a discount, basically, the share price on the net asset value. So is there a disconnect, or is this normal, or is this the standard when you have listed equity that hold private equity holdings?
Well, this is probably the one sort of drawback of the structure, is that you are a bit more open to the sentiment of public markets with the private equity trust. So your share price isn't fully linked to the NAV. It's independent of the NAV. So your NAV may be growing, but something might be happening in the broader world, which means that public market sentiment has decreased, and so your discount, your share price discount to NAV increases. So that's probably the one thing that some people kind of feel a bit reticent around, that impact. But look, I mean, PE trusts in general have traded at a discount for the last decade. Now, what this does is it does create a buying opportunity, I would say, in this marketplace. So, the discounts are typically around 20 to 30% at the minute as we speak. That creates a nice margin of safety for those that are entering the PE trust at the minute. But the important thing to remember is that even with the discounts, and they've been in the asset class really since the global financial crisis, the returns to shareholders from a share price total return basis have been strong as well. So over the last 10 years, annualized, the share price total return for our trust has been 13.4%. So whilst the discounts are there and attract a lot of headlines, I would say that the returns are still strong. And then secondly, it creates a nice margin of safety for those that are looking to buy in this particular market.
So if we move now to, the actual core business and what you earlier mentioned a little bit, we'd like to hear more about, how do you approach selecting and maintaining relationships with your GPs? What is the process? How does it move?
Yeah, so we have around 30 investment professionals tracking the market, and we divide our team up by geography and sector. So as you mentioned at the outset, I'm responsible for the Nordics, for larger pan-European funds, for Iberian funds. My job is to go into those geographies and really know every single GP that are based in those regions. And I need to build over time, basically, a list of these GPs and prioritize them. So I want a list of who are the high conviction, high priority GPs that I'm tracking. Which GPs are the ones to watch that are more emerging, that are coming through, that might be a candidate for us over time. And then the others that are perhaps, good GPs, investable, but perhaps further down that list. And then I have to then basically process those opportunities through our investment committee process. Have to undertake diligence. And when we're undertaking diligence on our GPs, it is thorough. We're looking at obviously the investment strategy of the GP, the team, the quality, how long they've worked together, the incentivization of that team, the culture of the firm is vitally important. We're looking at the investment governance, how their IC is constructed, how many people does someone have a veto right? We're looking at their value creation capabilities, their sector capabilities that allow them to create the alpha. We're looking at their ESG capabilities. Track record is probably only 20-25% of our score, because, as we know, persistence in private equity is pretty rare. So all of those go through our IC process, which is typically about 3 stages for our primary commitments, which is obviously making that decision on the GP. So it's a thorough process involving many team members, and allows us to kick the tires quite thoroughly.
And so if we take, let's say, emerging managers that you mentioned, and you pinpoint them, between the time you see them and they're on your radar, and you might make an investment, how long and what happens to that? What's the key? What are the key elements?
Yeah, well, if it's a first-time manager, for example, I think a key thing for us would always be if we worked with them before. Have they come out of one of our core GP relationships and are now setting up on their own? That's always helpful if we have that existing relationship and an element of trust. An understanding of their capabilities. So that's a key thing for us. Often, if someone's set up on their own, we can back them in their first fund, and it will be, I wouldn't say, maybe a bit more thorough in terms of our diligence. So, for example, things like the team. Have they worked together before? Have they been in the trenches together? Because that's often when things become apparent, where they might have a good relationship from afar, but when you're day to day, really in difficult situations, cracks might emerge. So really understanding the historic track record at their previous GPs, I think that's vitally important. Operational due diligence as well is hugely important in a GP that's setting up for the first time. Do they have the appropriate back office, valuation policy, cyber security, all of those things that's probably a bit more unglamorous when it comes to due diligence. That's hugely important when you're talking about an emerging GP. So it's still the same things we look for in our GPs more generally, but there's the diligence probably needs to go deeper in certain areas than you would do for a manager that you're backing for the third or fourth time.
And so when you track, you mentioned these, if a GP, if it's an emerging manager that came out from, a GP with whom you've had a relationship and you've worked with, how do you basically know that he was one of the top guys in finding the deals and executing the deals versus just riding off the wave? How do you know that?
Well, that all comes from how closely you've tracked your existing bench of GPs. And we like to form strategic relationships with our GPs. So be on the advisory committee, for example, work with them on secondaries, on co-investments. We don't really like to partner with GPs, exceptional as they may be, that see LP capital as a commodity. We want to be a strategic partner. And so we would like to think, given certainly in our trust, in Patria Private Equity Trust, the average tenure of a GP there is probably over 10 years. By seeing over that sort of time period, whether a GP, how the GP operates, whether they fulfill and live up to their promises, seeing what individuals are genuinely the ones that are driving things forward. I would like to think that the way that we partner with our GPs over such a long period of time would give us the insight into an emerging GP where one of the key protagonists have come out of one of our relationships.
And so it's more difficult for an emerging manager that you've never worked with, that you've looked from afar or you've put on your radar, versus one that you've worked actually within an existing team and who branched out.
Yeah, I mean, it's going to take more work. It's not easy, and we see a lot of these things, and we decline a lot of the emerging opportunities. But the important thing to note as well is that when these emerging managers work out, they can deliver some fantastic returns, because at the smaller end of the market, often taking expertise and that institutional knowledge from more the upper mid-market, and taking it more to the small cap, lower mid-market end, where things are perhaps less efficient. And, we've seen numerous examples of emerging GPs really knock it out of the park with their first fund. So that's a sort of risk reward. It's a more difficult diligence. It's perhaps a little bit more volatile, but when things go right, they really go right.
And so is there a size that that sweet spot for you in terms of the AUM that these managers target?
Not the AUM. I think fund size, we can go as low as sort of 100 million fund size, I would say.
But I mean, in terms of return, so have you noticed a link between the size of the fund of these emerging managers and the returns, or is it, because they're in a smaller sizes, it's pretty much the same?
No, it's not this. It's not pretty much the same. We see smaller managers, and it stands to reason. I mean, you expect this, that smaller managers deliver a much higher upside. There's a bit more volatility. So on an average basis or a median basis, smaller managers tend to have slightly higher performance on a TVPI and IRR basis compared to large cap. But the real difference is in the top quartile performers. Top quartile performers completely outperform, and that's what we see. And that's what I'm saying, that when things go right, the potential outperformance is quite incredible, actually.
So your strategy, you have, you invest in GPs, but you also do direct investments. How do you balance both?
So it's a good point, because there are a number of GPs, very high performing GPs, that don't offer co-investment, that stick within their lane. And so that's the balance. Sometimes you make a a primary commitment, knowing that there's unlikely to be much in the way of additional deal flow. But then sometimes there's a GP where perhaps the performance isn't quite as strong, but there'll be a good flow of other opportunities at the back end. For us, it's about creating and building deep relationships over many, many years, where you sit on that advisory committee, where you work with them on co-investments, on secondaries. So for us, yeah, there is that balance, because we do need to drive direct investment flow. So occasionally we'll back a GP knowing perhaps they're not going to offer that much in the way of co-investment, but the returns on a primary basis will be terrific, or we think they'll be terrific. But most of our GP relationships throw off co-investment, and that is linked to the fact that we've known them a long time and worked with them deeply over that time period.
And so, if you take the co-investment part, do you wait for the GP to offer what's available, or do you have the ones that you want to be in?
It's kind of a bit of both. I mean, you can see their deal flow, and you can certainly ask and be proactive, and we are. Quite often the GPs have a very clear idea of what they want to syndicate based on equity check size and their ideal hold in the fund. So yeah, we're certainly proactive, but the GPs have a very strong view on the assets they want to syndicate, and the assets whereby perhaps the equity check isn't quite enough for the fund, and so there isn't any left over for LPs.
All right. If we move on to the macroeconomic situation, we're seeing a lot of, let's say, instability factors. How does that affect your decision process?
Well, I think you need to be invested in private equity through the cycle. You can't just stop. It's a long-term asset class, and often we've seen in the past, on the back of the dot-com bubble, on the back of the GFC, you get these fantastic vintages, these fantastic periods of time during the worst turbulence. So you have to stay invested. That's when sometimes assets that have been long held by families, for example, suddenly become available, or P2Ps of great businesses that are only available in the public markets suddenly become available. So you often get differentiated deal flow through these periods. So it's important to stay invested. But conversely, we see with the broader market, quite a lot of people treat private equity, when the cycle turns, that they're very quick to sell, or when the cycle's at its peak and they're hunting for yield, they come into the asset class. It's almost like they come in at the wrong time and they exit at the wrong time. So first thing is we want to stay invested and get access to potentially very interesting vintage years. I think that depending what we look at, whether it's a fund, whether it's a direct, the influence of things in the macro environment slightly differs. So take tariffs, for example. If we're looking at co-investment now in an asset that's a physical goods producer, goes across US lines, then we're going to be really focused in on the tariff risk. If we're looking at a GP, for example, we're committing to a fund for 10 years, we're probably more sticking to our knitting around those factors we discussed earlier about the strategy, the team, the culture, the value creation capabilities, the sector expertise. We're probably more focused on those factors because they will deliver, or we think they will deliver, come what may, in the broader macro environment. So it differs depending on what we're looking at, but certainly we want to stay invested through the cycle for the reasons I just gave.
You mentioned in a certain way that people follow the hype, so they go in at the wrong time, they go out at the wrong time. Today, there's sort of a new hype around Europe, and that Europe is the place to be, and where private equity needs to build up. You are focused on Europe. Do you see that there is still a better opportunity within let's say, mid-market, or do you see that the larger cap deals also present opportunities?
Well, I think it's really interesting for me as someone that manages a trust that's focused on Europe principally, to see how the sentiment has shifted. Because for a number of years, I've had to defend Europe versus the US, which has been growing incredibly. So it's a welcome change in my book. I think Europe is really interesting and has been for years because it is a heterogeneous market compared to the US. So different languages, cultures, regulation, legislation, it's complex. And so it's very difficult for those outside of Europe to fly in and out and win a deal over those that have boots on the ground and are well integrated into the network. So accessing the best managers on the ground is vitally important to deliver returns in Europe over the long term. I think Europe right now, if you look at interest rates in continental Europe, they are significantly lower than the US and expected to increase below 2%. That has big implications for private equity activity as well. So that's probably why last year we saw the European markets recover faster than the US ones. The defense spending, the spending in Germany, that again has the potential to catalyze various sectors, industrial sector being one. So there's actually quite a lot of nice factors in Europe, as well as the fact that it's it's the birthplace and the leader in terms of ESG and sustainability. So there's good trends and themes there as well. So you'd be unsurprised to learn that I'm a big supporter of Europe, given our trust's focus. And then to the point really around larger cap and mid-market, we focus on mid-market, which we define as sort of 100 million to $1 billion enterprise in euros, enterprise value in euros. Why do we like that versus large cap? Well, it's a less intermediated part of the market. There's a lot of primary deals where you're buying from founders or families. The entry pricing is typically lower. The leverage is typically lower. There's more opportunity to create value in the underlying businesses because they're less professionalized. There's more exit optionality because you can sell into large cap private equity as well as trade buyers or even list the businesses should you wish. And then, I mean, historically, it has outperformed sort of the lower mid market versus large cap. The lower mid market has outperformed, and we think as you go forward into an environment where interest rates aren't zero, that will be even more pronounced.
And so do you have, could you share with us like your, let's say a Patria Private Equity Trust deal? What does this deal look like, today? What is there specific sectors that you prefer? You mentioned the size, but could you walk us through like, this is what we like, this is how we execute?
Yeah, so I mean, the sectors we prefer, I mean, tech and healthcare are our largest sectors. I think combined they're around 45% of the book, and we like asset light sectors or sectors that are more kind of recurring in nature. So consumer staples is quite a large component, sort of 10-12%. Business services, large component as well. So those are the sectors that we really like. So to give you an example of what we do, I mean, as I say, we're trying to invest in businesses that are between 100 million and $1 billion at entry, but those businesses can grow to be much larger. The asset that we've held the longest and is our largest asset is a business called Action, the discount retailer in continental Europe. Now, it's certainly not a mid-market business anymore, but it was when we first invested. So this kind of gives you the full journey, the primary, secondary, and direct investment nature of our strategy. When we invested in Action alongside 3i in 2011, it was through our primary fund investment in 3i Eurofund 5. So the fund made the investment in Action. At that point, Action was a Netherlands-based discounter. So it was only in the Benelux at that point. At that point in time, we saw value in increasing our exposure to 3i Eurofund 5 through making secondaries. So we bought additional exposure to that fund at a discount to NAV. And Action turned into this incredible success story, expanded into France, expanded into Germany, Southern Europe, and really showed strong growth in terms of its store footprint, but also organic growth, and really became a wonderful investment for that fund. Delivered around 30 times its original cost. So when that realized in 2019 through the fund, we took half of our proceeds and we reinvested those into a direct investment alongside 3i, and have held that since, trimming our position from time to time. But that business now has turned into a large business across, I think, 10 or 11 countries in continental Europe, is benefiting from its scale. The virtuous circle of becoming larger and larger is giving them more power with suppliers, more power with landlords. I believe they're teaming up with Lidl for new sites, so giving them real power and ability to get the best possible deal for the company. So its growth has continued. So that remains our largest investment, and a lot of people would look at that and say, well, that's large cap, but we've been in it for about 15 years now, and really through its entire journey alongside 3i, and it's an incredible business.
And so you mentioned this co-investment deal was 15 years ago. If we compare today, are co-investment opportunities much more competitive and tough to get in, or are you in a position to find your way every time?
I think they were a few years ago. So if you look probably around 2021, 22, I think co-investments were very competitive, but a lot of deals were getting done. So I think most people got what they wanted. I don't think co-investments are as competitive today. You know, I might be wrong on that, but there are a lot of investors in terms of institutions that they're waiting to private equity, or they're full up with private equity. We've seen that slowdown in the exit market, and so less distributions being returned. And you know, I think in the large cap segment in 2024, the cash yield was around 7 or 8%. So that's the distributions divided by the opening NAV. So investors are getting less cash coming back. You know, that figure used to be around 20%, 25%. So people have less money to invest in private equity and do co-investments, and at the same time, GPs, I think, are being cautious in terms of their deployment. They're undertaking buy and build strategies. So we've seen quite a lot of co-investments come in mid-investment, so to speak, where a GP's seen an interesting transformative acquisition and has brought in co-investors to help fund that. So no, I don't think co-investments are especially competitive today vis-a-vis 2022, when things were very competitive. I think the key thing is always with co-investment is to have a dedicated team that can react quickly to these opportunities, that can give a quick yes or no to the GPs, which gives the GPs confidence they can work with you in the future, because you know, they've got certainty. The last thing you want to do in co-investments is hang around the hoop right to the end and then not deliver the check. That sort of puts a black mark against your name, and sort of probably means that GP won't work with you again. So that's absolutely what we try to avoid, and we have a dedicated team that helps us do that.
So less competitive co-investment deals because there's basically less exits within the private equity sector. Do you see today secondaries as an opportunity to invest, or do you see it as a tool for liquidity?
Well, through the cycle, we see it as both. I think you can be proactive around both sides. So last year we were net sellers in the secondary market for the trust. We sold a book of around 180 million of sort of tail end or non-core fund positions, as we saw it, like good funds, like managed by good GPs, but just where we were just wanting to pivot more towards the lower mid market and or where these funds have been held for 10 years or more. So we were net sellers actually, and we saw good amount of activity and interest in that portfolio. I think as we sit today, we're probably more likely to be net buyers. As I mentioned before, it feels like there's a lot of people in private equity, a lot of institutions in private equity that have been waiting for distributions to pick up for some time, really since the second half of 2022. And I think a lot of people in the industry thought 2024 would be an excellent year or a good recovery in exits. We saw a little bit of that in the second half of the year, but the first half was a little bit weaker. And then a lot of people were pinning the hopes on 2025, and then this chaos from the tariff discussion, caused a lot of processes to be paused, delayed until maybe the second half of the year. So people have been waiting for exits to pick up and money to be returned to them. And I think a lot of people perhaps will take a view, look, we have to take it into our own hands now. And so we might see some interesting books coming to market. At the same time, you're probably seeing these portfolios where there has been underperformers. A lot of the pain has been taken, where, if you take the 2021 vintage, it's no surprise that some of these assets now, from an entry pricing point of view, perhaps they're, the GP slightly overpaid for those assets during that time period, and now have been remarked down. I think these portfolios, perhaps a lot of pain has been taken, and so there is that opportunity, I think, or there will be that opportunity as we move ahead. So we're more likely to be net buyers now that we've cleaned up the tail of our portfolio. But over the long term, we both buy and sell in the secondary market, and it's just a part of active portfolio management.
And is there a preference in the type of secondaries that you have, or is it, you just look at everything, whether GP led or LP led on your side?
Yeah, it's a mix, really. So the LP led stuff you typically buy at a good discount. It can be quite diversified and provide a good backbone to your portfolio. On the GP led side, often much more concentrated, often can be single asset, and so we would take a view on that particular company, whether just like a co-investment, I suppose. So it's a mix for us, and we also do secondaries of fund of funds, less so in our trust. In fact, we haven't done that in the trust at all. But in our broader portfolio, we can also buy fund of fund positions as well. So we've kind of got those three strands: the sort of fund of funds, those sort of LP led LP positions, but then the GP leds as well.
And there's been a lot of discussions around continuation funds being a tool of misalignment between LPs and GPs. How do you approach them? Are you willing to invest in continuation funds? And what are the safeguards that you put forward in order to make sure that interests stay aligned?
Yeah, well, we do look at these opportunities. We're active here in this part of the market. Look, I think the process has become more standardized over the last 6 or 7 years. We have ILPA guidelines around this. I think the template is there, but you still need to treat each one individually. I think for me, the key things are, firstly, is there proper price discovery? If you have that, it's been properly tested in a competitive process, then that gives the comfort to existing LPs, selling LPs, that they've got something like the appropriate price for the asset. I place less reliance on fairness reports and things like that are constructed by Big Four accountancy firms. It's more kind of, look, has there been a competitive process there? And then secondly, there's a roll option for existing LPs. I think every single one of these should have an ability for the LPs to roll, and at terms that are pretty similar to what they've already got. So I know that's quite hard, because sometimes the whole reason for the continuation fund might be for an asset to undertake buy and build, for example, and so you need to contribute a bit more, commitments to enable that. But having something that sort of gives the LPs the feeling that their terms are largely unchanged, they're not being penalised in any way for rolling. So I think those are two key things, and obviously the GPs need to manage their own internal conflicts. I think working closely with the advisory committee of the fund is really important. So yeah, there's definitely conflict management that needs to be addressed in these processes. But I think we're getting a nice standard template, but it's important for LPs to just remain on their toes around these processes.
You've mentioned, that the relationship with GPs are always long-term, and you've given us, examples of situation where the GP grew and there was basically a positive outcome. What happens when it goes sideways and it doesn't go well? How do you handle that? How do you, break up with the GP?
Oh, breakups are always hard. You know that. I think it's important that you have to undertake the difficult conversations. You have to be direct with them. I feel like sometimes LPs don't really appreciate the power that they have. But sometimes as an LP community, we sort of operate individually, whereas the power of the collective is meaningful. So often you need to work with other LPs to make sure everyone's aligned, the GP's getting the same message from across its investor base. That's why we like to be on the LPACs. I keep mentioning that, but the advisory committees being there, having that ability to really influence is super important. But we've had a number of these situations, and look, we've been around for 30 years, so we're going to have had a number of these situations. They're time consuming and often for little upside. So we've kind of learned, when the writing seems on the wall, use that secondary market, even if you have to sell the fund position at a discount. It's important, I think, sometimes just to cut your losses, particularly in something like our trust, Patria Private Equity Trust, where it's an evergreen vehicle and we can redeploy those proceeds into a new investment and move on. These processes where a GP goes bad, they can take up a lot of LP's time on various calls. If it goes to legals, for example, so they can be costly and time consuming. And sometimes it's just better to take your losses. But yeah, being direct with a GP, not shirking your responsibilities as an LP, I think that's important.
I'd like to move, now more on your, personal journey and career. And so what appealed you within private equity, and what keeps you engaged today?
Yeah, so I started my career like 20 years ago in sort of audit and accounting. So I did my accountancy back then, and I didn't feel it was for me. And I was always interested in sectors and companies, like what made a great company, come to be. Like, what is the thing that differentiates this company from another company does a very similar thing? So I was very keen to get more towards the front office, and then the global financial crisis hit, and it was a bit of a crazy time for everyone. I got the opportunity to join the private equity firm at what was the Bank of Scotland, was taken over by Lloyds Bank, as you mentioned in the outset. But I also had an opportunity to join a team in real estate as well. So it was a kind of sliding doors moment, but I much preferred that focus on businesses of different sectors and kind of understanding the way the world ticks, really, from a business point of view. And that remains today. That interest remains today. That's what keeps me excited about this industry, and seeing when a business does really well, seeing when one of your investments really knocks it out of the park and you've delivered returns to investors and shareholders in the trust, that that's still a thrill. So yeah, that's why I'm still here doing what I do. I really enjoy it.
Usually private equity or venture capital takes a lot of your time, and so do you think that there is in this type of career what they say a life work balance that can be done, or is it all work and you have to love your work?
I mean, it's not 9 to 5 in this industry, but you can make it work. You've got to have confidence in yourself, and you've got to be, productive and not waste time in any way. I mean, I've got 3 young children between the ages of 9 and 3, and you want to be there. These are precious years where you want to be there. You want to spend time with them. You want to create the memories, not just for yourself, but for them. And so for me, I feel like I have to be disciplined about things. I mean, the beauty of the last few years, one of the silver lining, I suppose, from the COVID era is that working from home is like much more accepted. Now, we're in the office the majority of the week, but for example, if something needs done, and I have to work in the evening or the weekend to get it done, I can work from home. I can balance things and make it work. That is a big difference from before COVID, where I guess working from home was seen more as sort of, they're skiving, they're going to play golf at 3 p.m. or something like that. Now it's much more accepted. For me, that's been a huge step change. Given my, how much I want to be there for the children and not miss meal times and not miss bath time. Which is difficult because this industry requires a lot of travel as well. So naturally, you do need to be away from your home anyway. But the key thing I think for me is being disciplined. It's avoiding that temptation of just being present for no reason in the office. It's being explained to people where necessary. Look, I need to be at home today. There's something on. Family really does come first.
And so family, you mentioned family is important, and to be straightforward, it goes with the philosophy that you have within your business and the long term and the relationship. So there's a kind of same guideline there. Is there other things that help you, once you're not working, to resource and to be better for your business?
I think it's important to have some downtime. Mm-hmm. It's important to have separation, I think. And that was probably the other side of the coin during COVID. You didn't have separation. I mean, during 2021, it was so busy. And I was sitting at my desk basically from early morning through to 10, 11 at night, consistently, day after day, with some breaks in there. But I did actually eat, so that's helpful. But having that ability sometimes to just get away from it and switch off allows you to come back more, I suppose, revitalized and with more energy. So I mean, I enjoy going for walks with my family. From a hobby point of view, play tennis, play golf, things that allow me to switch off, and then when I come back to work, I can really have that energy and that dedication.
You've mentioned discipline. Is there other qualities you think are important in this business today?
It's still a performance culture. So I think the ability to work hard and drive things through, I think is important, given what we've all said, but find that balance. But it is a performance culture. I always feel like the issue some private equity firms have is hubris, and that can often be the making of their downfall. So having that ability, that finding that balance between having the confidence, full belief in yourself, but the humility to also question, look, I might be wrong here, or speak to people on a level. I think that's reasonably rare in the industry, but when you find it, it can be quite powerful. So I think that is something that we look for in our GP relationships. People that have their feet on the ground, but incredibly talented, hardworking, but aren't I don't know, aren't getting ahead of themselves, I suppose.
I'll conclude with the last question that, one of the person I interviewed recently said that private equity, whether LPs or GPs, the role was coming to an end because AI was going to do everything. Do you tend to see the same thing, or do you see it more as a tool that can help you make better decisions, basically?
Wow. I don't think anyone knows really what Gen AI is going to create in almost any industry right now. I mean, you've got these people that they're saying it's the end of the, I don't know, the white collar worker. I mean, that could be the case. Who knows? But my suspicion here with this industry is that it will certainly mean that it will make things a lot more efficient. So in terms of data, in terms of analysis, Gen AI will help speed that up considerably. But I still feel like you need to see the whites of someone else's eyes. You know, if you're a GP investing in a business, you need to really assess and understand and build trust with the CEO and the management team of those businesses. Likewise, LPs. If you're making a primary investment, that is an investment in people, essentially, and having confidence in people and their ability to create returns. Can AI fully solve that? I'm not so sure. I do think it probably does mean that, GPs and LPs, you probably won't need as many people if we're sitting here in 5-10 years time because of this technology change. But I still think the role of people is vitally important.
Alan, thank you so much for your time. It was really insightful. Thank you.
Thank you very much.